So it's late August 2026 right now.
Right.
And, summer vacations are kind of winding down. People are looking toward Labor Day, back to school, all of that.
Yeah, the busy season is wrapping up.
Exactly. And fall is usually when people are, they're making these big life decisions, like buying or selling a home.
Mm-hmm.
But if you look at the Dallas metroplex right now, buyers are just, they're functionally paralyzed.
Like absolutely frozen.
Yeah, because we have mortgage rates still hovering above 6%, with APRs pushing 7% for a lot of folks.
Yeah, which is painful.
Very painful. And then you stack that with, the deep geopolitical unrest we're seeing in the Middle East. It's causing this massive flight to safety. Capital is freezing up. And as a direct result, Dallas home prices are actually correcting downward by over 4%.
Right, which makes sense.
It makes total sense.
Yeah.
And here's the wild part. If you get in your car and you drive just, an hour or two northwest into Jack County, you are looking at a market where pending sales have literally doubled. And the average sale price has just absolutely skyrocketed by 40%.
Yeah, it's wild.
6%.
It is honestly one of the most severe statistical contradictions I've analyzed in recent years.
I bet.
Because you have the broader North Texas ecosystem acting, exactly the way macroeconomic theory dictates it should.
Right. High rates equal low movement.
Exactly. In a high rate, high anxiety environment, capital retreats, inventory stalls.
Yeah.
But then you have Jack County behaving as if it's experiencing this unprecedented boom cycle.
And that structural contradiction right there, that is our sole mission for this deep dive today. We are going to cut through all the broader noise of the Texas real estate market by, we're triangulating a stack of incredibly granular reports from Peet Realty alongside raw data from the North Texas Real Estate Information Systems, which, by the way, if you're actually moving paper in this market, it's pronounced net trunts.
Right. Net trunts, the insider lingo.
Gotta know the lingo. But we are going to unpack the mechanics of how rural acreage is just completely defying the gravity of this 2026 market.
Yeah, it's a fascinating anomaly.
It really is.
Yeah.
But I think to understand the anomaly, we have to map out the baseline first.
Right.
What is the actual macroeconomic weather system sitting over North Texas right now?
Well, the current climate is it's really defined by friction.
Friction, yeah.
Yeah, because if you look at the national data from earlier in the spring, there was this illusion of a thaw.
Oh, right.
U.S. existing home sales unexpectedly ticked up. It was about 1.7% month over month.
Which got everyone excited.
Exactly. You saw volume moving in the Midwest, parts of the West, and that led some analysts to just prematurely declare this grand recovery.
Right. They were ready to call it.
Right. But real estate is inherently hyperlocal.
Always.
And our regional reality here in North Texas just firmly rejected that national narrative.
Yeah, the regional contraction here is stark. New listings in North Texas dropped 2.4%. And we saw that sharp 4.1% year-over-year price correction in the immediate Dallas area.
Right.
And the underlying mechanism there, it isn't just financial, right? The sources we have point heavily to a psychological blockade.
Oh, 100%. It's deeply psychological.
Because we have the sheer cost of capital. You're looking at, 6 to 6.8% depending on your loan vehicle.
Right.
And that is layered over the severe global instability. So when buyers see geopolitical unrest just dominating the news cycle every single night, the instinct is capital preservation.
Right. They want to hold on to their cash.
Exactly. It's not, hey, let's take on a highly leveraged 30-year asset right now. I was thinking about it like it's like a crowd of people standing at the edge of a freezing cold pool.
Oh, that's a good way to look at it.
Right. Everyone is standing there shivering in their swimsuits, just waiting for someone else to jump in first to see how cold it really is.
That is exactly what it feels like. And that psychological blockade, it's compounding the financial reality on the ground.
How so?
Well, the spread between the 10-year Treasury and mortgage rates, it remains stubbornly wide. So buyers are trapped, right? They're trapped between their desire to move, because life still happens, people have kids, get new jobs, and their absolute refusal to lock in at near 7%.
Right. Nobody wants that rate.
Exactly. And on the flip side, potential sellers are hoarding their pandemic-era 3% mortgages.
Oh, man, the golden handcuffs.
Yes. They are hoarding that cheap debt like gold. They won't let it go.
You can't blame them, really.
No, of course not. But what it does is the Dallas metro essentially becomes a frozen market. Capital isn't moving because the perceived penalty for deploying it is simply too high for most people.
Right, which makes the data coming out of Jack County almost impossible to process at first glance.
It really does. It looks like a typo.
Seriously. Because if capital is frozen and buyers are universally terrified of debt right now, a peripheral market, a rural market further out, should theoretically suffer first and worst, right?
Normally, yes. The outer rings cool off first.
Right. But the March 2026 snapshot for Jack County, it reads like a completely different economic reality. I mean, new listings jumped 9.4%. That's 35 new properties hitting the market.
Which is a healthy amount of inventory.
Yeah, but the demand side completely absorbed it and then some. Pending sales shot up 100%.
Wow.
14 properties went under contract in a single month, where Dallas buyers were literally just sitting on their hands.
Yeah, and closed sales followed suit, too. They were up 83.3% with 11 completed transactions in that window.
Which is huge for a rural county.
It's massive. You have volume accelerating in a macro environment that is aggressively suppressing volume everywhere else.
Yeah.
But, the component of this data that requires the most aggressive structural analysis is the pricing.
Oh, absolutely.
Because in March, the median sales price in Jack County grew 17.2% to $375,000.
Okay, let's unpack this. Because the median growth is impressive, sure. 17% is nothing to sneeze at.
Right.
But the average is what just completely breaks the models for me.
Yeah, the average is the outlier.
The average sales price rocketed 40%. 40%. Up to over $544,000.
Yeah.
I mean, the immediate assumption when you review a data set where the broader market drops 4% and a micro market spikes 40%, you think, okay, there's a reporting error here.
Right, or it's just a heavily lagging indicator.
Exactly. How on earth does a local market sustain a 40% average premium when the cost of borrowing is so prohibitive right now?
Well, it requires a total reframing of how we view the asset class itself.
Okay.
We have to basically discard the traditional suburban residential model.
Yeah.
The 3-bed, 2-bath, and a cul-de-sac.
Right.
We have to look at this through the lens of an illiquid premium asset. It's actually much closer to the commercial real estate space, or honestly, even the fine art market.
The fine art market, really?
Yes, because of how specific it is. And that massive divergence between the median and the average, that is our first major clue here.
Right, because median is just the literal middle point of all transactions, but the average gets skewed by the extremes.
Exactly. When an average spikes by 40%, but the median only moves 17%, it indicates a very specific type of capital deployment.
So we are basically looking at a handful of ultra-high dollar acquisitions, pulling the top-line metrics upward.
Precisely. You are seeing substantial multi-million-dollar ranch or large acreage transactions closing.
Wow, okay.
And the thing is, these aren't your heavily leveraged first-time home buyers who are subject to the whims of the current AQR.
Right, they aren't agonizing over a quarter-point rate hike.
Exactly. This is significant, often institutional or generational wealth moving into land. They have cash or they have specialized financing.
That makes so much sense.
But I want to be clear. The strength of the Jack County market isn't just a mirage created by a few wealthy buyers skewing the average.
Okay.
Because even if we isolate the median to just totally strip out those massive anomalies, the baseline growth is still immense.
Right, because the median was up 17%.
Right. And if we look at the wider first quarter of 2026, it showed a median of $260,000, which is a 20.1% increase year over year.
Man, so the baseline valuation of just average land in this county is rising aggressively regardless of the macro rate environment.
Yes, the floor is coming up rapidly.
So that upward pricing pressure, combined with that volume explosion we talked about, it suggests buyers are treating Jack County acreage as essentially a safe haven asset.
Yeah, a tangible place to park capital during turbulent times.
But when we look at the life cycle of these transactions, we hit this massive structural paradox.
Oh, it's the timeline data.
Yes, the timeline data. It directly contradicts the pricing data if you apply, standard real estate mechanics. Because in March, the days on market for Jack County was 103 days.
Right.
Over 3 months. And more importantly, the months of supply sits at a staggering 12.4 months.
Yeah, That's the number that jumps off the page.
That is an 11.7% increase in inventory year over year.
And that 12-month supply metric is really the crux of the whole anomaly.
Right, because if we rely on standard market fundamentals, what they teach you on day one of real estate school, anything over 6 months of supply indicates a buyer's market.
Correct. Inventory is stacking up.
Right. A 12.4-month supply means there is over a year of backlog.
Yeah.
In literally any traditional residential market, a seller staring at a year of inventory would be bleeding equity. They'd be slashing prices every weekend just to generate a little foot traffic.
Panic mode, absolutely.
Total panic.
Yeah.
Yet the data shows Jack County sellers are capturing 94.5% of their original list price.
Right.
How does a market sustain a 12-month supply surplus without a total collapse in seller leverage? I mean, they're getting what they asked for.
Well, the contradiction resolves itself when we examine the friction of capital that is inherent to rural and agricultural real estate.
Okay, tell me more about that.
You simply cannot apply suburban subdivision liquidity metrics to the farm and ranch sector. They're two different beasts entirely.
Right.
To understand this, the source material specifically highlights the operational perspective of David Peet.
Right, of Peet Realty out of Alvord.
Exactly. And his background is really essential context here, because he's not just some guy in an office moving paper. He operates in this ecosystem every day.
Right, he lives it.
He and his wife raise British white cattle. They manage retired Tennessee walking horses that actually utilize the North Texas LBJ grasslands.
Oh, wow, that's very cool.
It is. So when the reports note his, quote, keen eye for farm and ranch, unquote, it underscores a fundamental reality of this asset class. The buyer pool is hyper-specific, and the due diligence required is incredibly complex.
Right. The friction of the transaction is substantially higher. You aren't just sending an inspector out on a Tuesday to check the HVAC and look at the roof.
No, not at all. You are evaluating soil quality. You are looking at water rights, which is huge in Texas.
Oh, absolutely.
Agricultural exemptions, mineral rights, the integrity of the fencing infrastructure across hundreds of acres.
Yeah, that's not a weekend project.
Exactly. So the capital required and the specific utility the buyer needs, whether they need a working cattle operation or a seasonal hunting lease or just a generational family retreat, that drastically shrinks your eligible buyer pool.
So it's a needle in a haystack situation for the sellers.
Exactly. This market is inherently illiquid. That 12.4 months of supply doesn't necessarily indicate a weak or crashing market.
Okay.
It indicates a market that requires an extended timeline to match a highly specific asset with a highly specific buyer.
That makes perfect sense. It fundamentally changes the definition of days on market.
Yes, it does.
So 103 days isn't a stale listing in this context. It's not a red flag. It is simply the standard operational timeline required to execute a complex land acquisition.
Exactly.
The seller isn't dropping the price to 94.5% out of sheer desperation after 3 months. They are holding their valuation because they know the asset's inherent value to the right operator.
Right. And when that operator, that specific buyer, finally identifies the parcel that meets their agricultural or recreational requirements, they recognize the scarcity of that asset.
Yeah.
And so they pay the premium. They aren't just buying shelter. They're acquiring a producing asset, or they're securing a massive lifestyle footprint.
Right.
And that is how you sustain a pricing boom inside of a 12-month inventory cycle. The patience of the capital dictates the terms, not the velocity of the transactions.
The patience of the capital. I love that. And that concept of, hyper-specific markets within a larger ecosystem, it brings us to what might be the most dangerous trap in this entire data set.
Oh, the county level averaging.
Yes. When we talk about quote-unquote Jack County, we are projecting a monolith that doesn't actually exist on the ground.
Not at all.
The fragmentation here is extreme. If we dissect the first quarter 2026 Market Watch report, it becomes immediately apparent that treating county-level averages as actionable intelligence is a massive risk.
It was incredibly risky.
Because the microgeography dictates completely different economic realities.
Yes. The danger of the county average really cannot be overstated here. If a listener, a buyer, or an investor is relying on that top-line 20% median growth to guide their strategy, they are flying completely blind.
Right. They might step into a bear trap thinking it's a gold mine.
Exactly. So let's analyze the 4 primary ZIP codes in the Q1 data, because they essentially represent four distinct microeconomies operating under completely different sets of physics.
Let's do it.
We look first at ZIP 76431.
Okay.
The closed sales volume here just detonated. It was up 600% with 14 transactions.
600%. That is wild.
Right. Yet, despite that massive acceleration in velocity, the median price remained entirely flat at $393,000.
Okay, so a 600% increase in volume without moving the price needle at all. That suggests a massive unlocking of inventory at a very specific, agreed-upon market clearing price.
Yes.
The market just found absolute equilibrium instantly.
Exactly. The demand perfectly absorbed the supply at that specific valuation, and it did it without triggering a bidding war that would drive the median up.
That is fascinating. Okay, what's next?
So contrast that immediately with ZIP 76458.
All right.
The behavior flips entirely. Volume still doubled. It was up 100%, but the median price surged 57.6%.
Wow.
Landing at $260,000.
Okay, that was a very aggressive price discovery.
Oh, yeah.
It's like buyers identified that sub-$300,000 threshold as undervalued, and they just flooded in, rapidly driving the floor up.
That's exactly what happened. They aggressively repriced that specific geographic pocket because it was affordable relative to the rest of the county.
Okay, so we have one zip code perfectly balanced, one seeing a massive price surge.
Right. But the narrative fractures completely when we move to ZIP 76486.
Okay, lay it on me.
This is your premium tier area. The median price sits high at $545,000.
Okay.
However, that represents a severe 19.3% contraction year over year.
Down 19%.
Down 19.3%. Alongside a total freeze in velocity, there are only 4 closed sales in the entire quarter.
Oh, man. So that is the pocket feeling the macroeconomic weather.
Exactly.
The higher the price point, the more sensitive the transaction becomes to the cost of capital, unless it's an all-cash institutional buy like we talked about earlier.
Right.
So the buyer is willing to finance a $500,000 land acquisition at 7%. They simply vanished, leaving that ZIP code just stalling out entirely.
Yep. They hit their pain threshold and backed away.
Man. Okay, what's the last one?
Rounding out the map, we have ZIP 76487. In terms of pure transaction count, this was actually the most active sector. There were 19 sales.
Okay.
But that actually represents a 47.2% drop in volume from the previous year.
Wow, almost half.
Yeah, while simultaneously maintaining a really strong median of $444,000.
Okay, so a massive volume collapse combined with total pricing stability. It sounds like sellers in 76487 are stubbornly holding their line. They are refusing to discount their land, resulting in just far fewer deals actually crossing the finish line.
That's exactly it. It's a standoff.
Wow. When you synthesize these 4 ZIP codes, the strategic implications for the listener are just profound.
Oh, completely.
Like if you hold acreage in Jack County and you assume you have total leverage just because the county average is up 40%.
Right, you read a headline and think you're rich.
Exactly. But you might actually be sitting in 76486 where valuations are dropping 20% and nothing is selling.
Yep. The micromarket dictates the leverage. Period. If you are operating in 76431, you have unprecedented momentum. If you are in 76486, the buyer holding the capital dictates the terms of the engagement.
Wow.
And this fragmentation is exactly why actionable intelligence requires drilling down past the top-line headlines. You have to know your specific dirt.
You have to know your dirt. I love that. Well, let's pivot that intelligence into pure strategy then.
Well, let's do it.
Because we are looking at a market in late 2026 that is characterized by 12 months of inventory, intense geographic fragmentation, and buyers who are, generally paralyzed by the cost of capital.
Right.
Yet some of them are still willing to pay heavy premiums for the right asset.
Yes.
So for the listener who is looking to either deploy capital or maybe liquidate an asset right now, how do they actually navigate this exact matrix?
Well, the foundational metric driving strategy right now for everybody is the 10-year Treasury yield. It is currently acting as a concrete floor above 4%. And as long as the 10-year remains elevated there, it physically restricts mortgage rates from returning to those historical lows we saw a few years ago.
Right. So the idea of a rapid return to 3 or 4% mortgage rates, that's just off the table.
It's a fantasy right now.
Yeah.
However, we do have to look at the forward projections.
What are they saying?
The Texas A&M Real Estate Research Center forecasts suggest that if macroeconomic inflationary pressures continue to ease, we could potentially see mortgage rates slide into a range of, say, 5.0 to 5.6% by late 2026.
Okay, so a softening, but not a collapse in rates.
Right.
But, the natural instinct for a buyer looking at that forecast is hesitation,
Of course.
right? If I know rates might soften to 5% in just a few months, why wouldn't I just wait? Why on earth would I deploy capital at 6.8% today?
Because waiting for a market-wide rate cut in a heavily suppressed market is a catastrophic misallocation of leverage.
Okay, explain that. Why is it catastrophic?
Think about it. If you wait for the rates to drop to 5%, you are timing the market alongside literally every other paralyzed buyer in the Dallas-Fort Worth metroplex.
Oh, I see.
Right. When that psychological dam breaks, when people finally see a 5 in front of the interest rate, the pent-up demand is going to flood the zone.
Right, everyone jumps in the pool at once.
Exactly. So the moment you secure that cheaper 5% debt, you will instantly forfeit those savings by entering a hyper-competitive bidding war that drives the principal acquisition cost straight up.
Wow. You trade a high interest rate for an inflated purchase price.
Yes.
Which is ultimately so much worse because, you can refinance a rate down the line, but you cannot renegotiate your principal after closing. The price is the price.
Exactly. You are stuck with that principal forever.
Yeah.
So the optimal strategy, supported by the current data, is to utilize the existing market friction to your advantage today.
Okay, how?
Well, in Jack County, you're looking at sellers who have been on the market for over 100 days.
Right, the 103 days on market average.
Yes. And they are staring at 12.4 months of competing inventory all around them.
So they have patience, but they also have carrying costs. I mean, holding land isn't free. Taxes, maintenance, it adds up.
Exactly. It bleeds you slowly.
Hmm.
So as a buyer operating today, you represent rare liquidity. You are the unicorn that actually has the capital to close.
Right.
And you use that leverage not necessarily to crush the seller on the purchase price, because we know from the data they are holding firm at 94.5% of their list price, but you use it to negotiate heavy concessions.
Ah, okay. Like what kind of concessions?
You structure the deal so the seller funds a rate buy down.
Right.
You essentially manufacture your own transition to a lower interest rate using the seller's equity, avoiding the future bidding war entirely.
That is brilliant.
It works.
Yeah.
You secure the asset at today's valuation without the competition, but you get tomorrow's interest rate because the seller paid for the buy down to get the deal across the finish line.
That is a masterclass in utilizing high inventory as a mechanism for leverage, rather than just seeing it as a warning sign and running away.
It's all about how you frame the data.
It really is. But we have to flip the board here.
Sure.
If I am holding land in Jack County right now and I see that massive flood of buyers coming when rates eventually soften to 5%, what is the optimal path for me as a seller?
Well, the strategic imperative for sellers right now is aggressive, proactive preparation.
Okay.
The David Peet methodology highlighted in the materials is completely unambiguous here. The preparation phase must happen before the market shifts, not in response to it.
Right, you can't be reactive.
Exactly, because when that 5% threshold is breached and buyers flood the market, you are going to see a massive corresponding spike in new listings from all the other sellers who are also waiting on the sidelines.
Oh, right. So the inventory problem could actually get worse.
Precisely.
So if you wait for the buyers to arrive before you start, fixing your fences, clearing the brush, painting the barn, you will drown in the wave of competing inventory hitting the market simultaneously.
Yes. The asset must be pristine and fully optimized the very moment the capital unlocks.
That makes a lot of sense.
But, and this is crucial, preparation in the farm and ranch sector requires incredibly precise capital allocation. You cannot just apply suburban upgrade metrics to rural land.
What do you mean? Like, don't put in granite countertops if they just want a hunting cabin?
Exactly. You must consult a specialized partner to analyze the return on investment for every single dollar spent.
Right.
Spending capital to renovate a structure might actually yield negative ROI if the likely buyer for your specific parcel intends to just clear the land for agricultural use anyway.
Oh, wow. So you could spend 50 grand fixing up a farmhouse that the buyer's just going to bulldoze on day one to make room for more cattle.
Exactly. It's wasted money. It reinforces the extreme danger of that 12-month supply metric. In a market where inventory sits for over 100 days on average, the penalty for misjudging your initial pricing or your capital improvements is incredibly severe.
Yeah, because it's the quickest path to creating a stale listing.
It really is. If a seller in this environment aggressively overprices their land by 20% just to, test the market,
Oh, people love to do that. Let's just see what we can get.
right, well, that property will languish because buyers tracking a 12-month supply market are highly educated.
They're watching everything.
They are. When they see an asset sit for 200 days without movement, they don't see patience. They assume there are structural, legal, or agricultural defects with the land itself.
What's wrong with it?
Exactly. Is
Yeah.
the well dry?
Yeah.
Are the mineral rights leased out?
Yeah.
And they bypass it entirely. The 94.5% list-to-close ratio confirms this. The transactions actually crossing the finish line are the ones priced with absolute accuracy from day one. In a high-inventory, high-friction market, there is zero margin for speculative pricing.
Zero margin. Wow. Synthesizing this entire ecosystem, it just reveals a truly fascinating dynamic.
It really does.
Because we are navigating a broader North Texas market that is visibly straining under the weight of expensive capital and geopolitical anxiety. It's resulting in stall velocity, correcting prices in the suburbs. Yet, zooming in on Jack County exposes this robust, premium-priced microeconomy that fundamentally ignores those macro pressures.
Yeah, it operates by its own rules.
The farm, ranch, and acreage sector operates on an entirely different frequency. It requires immense patience from sellers who might wait, a third of a year to close, but it heavily rewards that patience through sustained high-margin valuations.
It is a profound isolation of an asset class. The mechanics of Jack County right now prove that not all real estate is subject to the same economic gravity.
That's a great way to put it.
The rural acreage market is dictating its own terms, and it's driven by buyers who prioritize long-term utility and absolute asset scarcity over, short-term interest rate fluctuations.
Right. Which brings us to the underlying shift this data might actually be signaling.
Okay, where are you going with this?
Well, we spent the first half of this decade analyzing the pandemic-driven urban flight, right?
Sure.
The realization that remote work untethered professionals from city centers, and it pushed suburban sprawl further and further out.
Yeah, the race for space.
The race for space. But as we analyze this late 2026 data, a much larger, honestly more philosophical question emerges for me.
I'm listening.
When we see massive price premiums holding firm in rural counties despite prohibitive borrowing costs and massive inventory gluts, we have to question the trajectory of the asset class itself.
It definitely challenges the historical hierarchy of real estate valuation.
Exactly. Are we moving past the era where rural acreage was simply a niche retreat for agricultural operators and weekend hobbyists?
That's a fascinating thought.
Right. We might be witnessing the permanent repricing of acreage into the ultimate premium asset class.
Wow.
As urban density increases and the friction of city living compounds, raw land and space itself are transitioning from a utility into a pure luxury.
I can see that.
So it forces us to ask, over the next 2 decades, will the steady, isolated appreciation of places like Jack County consistently outpace the volatile, rate-dependent cycles of the traditional Dallas suburbs?
That is the big question. When acreage becomes the ultimate defensive asset, the entire geographical map of wealth distribution is rewritten.
A massive structural shift hiding in plain sight within the county data.
Right there in the numbers.
It is a phenomenal framework to evaluate your own position in the market as the seasons change and we head into the fall.
Well, thank you for diving deep into the numbers with us, and we will see you on the next Deep Dive.